You know what drives me absolutely crazy? Watching billionaires somehow get richer during every single market crash, while regular investors panic sell at the exact bottom and watch their retirement accounts get cut in half. It's like they're playing a completely different game with a completely different rulebook, and nobody bothered to tell the rest of us the rules even exist. The truth is, I spend way too much time studying what the ultra-wealthy actually do with their money. Not what they say in interviews, but what their SEC filings reveal they're doing 6 months before everything falls apart. If you want to understand how billionaires prepare for crashes while everyone else is still buying at the top, make sure to subscribe and give this video a thumbs up, because this playbook isn't actually secret. Most people just never bother to look. Here's something that should make you absolutely furious. During the 2008 financial crisis, the average investor lost 38% of their portfolio value. Many panic sold at the bottom and locked in those losses permanently. Meanwhile, Warren Buffett's Berkshire Hathaway was sitting on $44 billion in cash and went on a buying spree that generated billions in profits over the following decade. That's not a coincidence. That's a pattern. The same thing happened in March 2020. The S&P 500 dropped 34% in just 23 trading days. Retail investors fled the market in droves. But the billionaires? Many of them had already reduced their equity exposure months earlier and were loading up on cash, waiting for exactly this moment to strike. Let me show you just how rigged this game really is. According to Dalbar Research, over a 20-year period, the average equity investor earned just 5.19% annually, while the S&P 500 returned 9.85%. That's not a small gap. That's the difference between retiring comfortably at 60 and working until you're 75. The primary reason? Behavioral mistakes. Regular investors buy high during euphoria and sell low during panic. Billionaires do the exact opposite, and they do it consistently, almost mechanically. The data gets even more staggering. Research from JP Morgan shows that missing just the 10 best days in the market over a 20-year period cuts your returns nearly in half. And when do those best days typically happen? Right after the worst days, when average investors have already sold everything and are sitting on the sidelines licking their wounds. Here's the thing that really gets me, though. Most of this information is publicly available. Every quarter, hedge funds and institutional investors, managing over $100 million, have to file 13F reports with the SEC, disclosing exactly what they own. These filings are free to access. You can literally watch what billionaires are buying and selling, yet 99% of retail investors have never even heard of them. It's like having the answer key to the test and choosing not to look at it. The pattern before every major crash is remarkably similar. 6 to 12 months before the market falls apart, you start seeing smart money quietly reduce their equity exposure. They're not panic selling. They're methodically building cash positions, rotating into defensive sectors, and setting up hedges that will profit when the market drops. Carly Khan reportedly made $1 billion on bets against the market in 2020. George Soros built a legendary career on anticipating these exact moments. These aren't lucky guesses. They're the result of watching specific signals that most people completely ignore. The question isn't whether billionaires have an edge. They clearly do. The question is, what exactly are they seeing that tells them to start moving their money 6 months before the rest of us even know something's wrong? To understand what billionaires do differently, you first need to understand what they're actually looking at. Because here's the truth that most people don't want to hear. Market crashes aren't random events that nobody sees coming. They have warning signs, sometimes months in advance. The problem is that most investors are staring out the window at clear blue skies while the instrument panel is flashing red. Think about it like this. A commercial pilot doesn't just look outside to check if the weather is nice. They're constantly monitoring dozens of instruments, checking fuel levels, watching for turbulence ahead, receiving updates about conditions miles away. The average investor? They're basically a passenger staring out the window saying, "Looks fine to me," while completely ignoring the cockpit. Billionaires have built their own cockpits, filled with indicators and data feeds that tell them when conditions are starting to deteriorate long before the turbulence actually hits. Here's the thing about market crashes that most people miss. They don't happen overnight. The 2008 financial crisis didn't start in September when Lehman Brothers collapsed. The warning signs were visible as early as 2006 when mortgage delinquencies started ticking up. The 2000 dot-com crash didn't begin on a random Tuesday. Valuations had been screaming danger for over a year before the market finally rolled over. Even the COVID crash in March 2020 had credit markets and bond yields flashing warning signals weeks before equities caught on. The 6-month time frame matters for a very specific reason. When you're managing billions of dollars, you can't just log into your brokerage app and hit sell all. Moving that kind of money takes time. If Berkshire Hathaway tried to dump their entire Apple position in a single day, they'd crash the stock themselves. Large institutional investors need weeks or months to unwind positions without destroying their own returns. So they start early, gradually reducing exposure while prices are still high and liquidity is still abundant. This creates a structural advantage you can actually exploit, because these large moves leave footprints. When a hedge fund starts selling a significant position, it shows up in their quarterly 13F filing. When corporate insiders start dumping their own company's stock, those transactions are reported within 2 business days. The smart money can't hide what they're doing. They're required by law to tell everyone. Most people just never bother to look. The other advantage billionaires have is probabilistic thinking. They're not trying to predict exactly when a crash will happen. That's impossible. What they're doing is reading probability signals and adjusting their positioning accordingly. It's not about being right every time. It's about tilting the odds in your favor consistently over decades. And the good news? Most of these signals are publicly available. Now let me show you exactly what they're watching. Here's where it gets really interesting. The first indicator billionaires watch is something most retail investors have never even heard of. Yet it has predicted every single recession in the past 50 years. It's called the yield curve, and understanding it is like having a crystal ball that actually works. Here's the simple version. Normally, when you lend money for a longer period, you expect a higher interest rate to compensate for the added risk. A 10-year Treasury bond should pay more than a 2-year Treasury bond. That's just how things work. But sometimes this relationship flips. Short-term rates rise above long-term rates. That's called an inverted yield curve. And when this happens, it's essentially the bond market screaming that something is very wrong with the economy. The track record on this is almost eerie. An inverted yield curve preceded the recessions of 1980, 1981, 1990, 2001, 2008, and 2020. That's not a coincidence. That's a pattern so consistent that ignoring it is basically financial malpractice. The typical lead time is 12 to 18 months, which means when the yield curve inverts, you don't need to panic immediately. But you absolutely need to start paying attention and adjusting your strategy. You can check this yourself for free. The Federal Reserve Bank of St. Louis maintains a website called Fred where you can pull up the 10-year minus 2-year Treasury spread in seconds. When that number goes negative, the clock starts ticking. Most people have no idea this resource even exists. Billionaires watch it like hawks. The second indicator is credit spreads. This one tells you how nervous the smart money is getting about corporate defaults. A credit spread is simply the difference between what corporations pay to borrow versus what the government pays. When spreads are tight, around 100 to 150 basis points, investors are confident and willing to lend to companies at rates close to government bonds. When spreads blow out to 300, 400, or 500 basis points, fear is entering the system. Lenders are demanding much higher rates to compensate for the risk that companies might not pay them back. Before the 2008 crisis, credit spreads started widening months before equities peaked. The bond market saw trouble coming while the stock market was still making new highs. Credit spreads are essentially a real-time fear gauge for institutional investors. The third indicator is insider selling patterns. This one is particularly powerful because it tells you what the people who know these companies best actually think. When a CEO sells a few shares to diversify, that's normal. But when you see clusters of insiders selling across multiple executives at the same company, or across multiple companies in the same sector, that's a signal worth paying attention to. One alarm might be a false positive. 3 alarms going off together is a fire you cannot ignore. But watching indicators is only half the equation. Let me show you how to track what billionaires are actually doing with their money. Here's something most people don't realize. You can literally see what billionaires are doing with their money in real time, for free. Every institutional investor managing more than $100 million is required by law to file a 13F report with the SEC every quarter, disclosing exactly what stocks they own. It's like having a window into the smart money's playbook. Yet the vast majority of retail investors have never even looked at one. Now, there's an important caveat. These filings come with a 45-day delay. So you're not seeing what billionaires are doing right now. You're seeing what they did last quarter. But here's why that still matters enormously. When you're looking for pre-crash positioning, you don't need real-time data. You need to spot trends over multiple quarters. If a major investor has been steadily reducing their equity exposure for 6 months, that 45-day lag becomes almost irrelevant. The pattern is what matters. Let me show you how this works in practice. Warren Buffett's Berkshire Hathaway is probably the most watched 13F filing in the world, and for good reason. Before the 2008 financial crisis, Berkshire's cash position had grown to approximately $44 billion. That represented about 25% of their total assets, an enormous cash cushion by historical standards. Then came 2020. In the quarters leading up to the COVID crash, Berkshire's cash pile had swelled to a staggering $128 billion. When the market collapsed in March, Buffett had more dry powder than most countries' GDP. This wasn't luck. This was a deliberate strategy of building cash when valuations looked stretched and opportunities looked scarce. You could see it happening quarter after quarter in the 13F filings, if you knew where to look. Beyond cash positions, sector rotation is another massive tell. In the months before market downturns, you consistently see institutional investors rotating out of high-growth, high-volatility sectors and into defensive plays. Technology stocks get trimmed. Consumer discretionary positions shrink. Meanwhile, utilities, healthcare, and consumer staples start showing up more prominently. These aren't exciting sectors. Nobody brags about their water utility holdings at cocktail parties, but they hold up best when everything else is falling apart. Stanley Druckenmiller's moves before the 2022 downturn are a masterclass in this approach. In the quarters leading up to the market peak, his filings showed systematic reduction in growth stock exposure and increased positions in energy and commodities. When tech stocks crashed 30% or more, his portfolio was positioned to weather the storm. All visible in public filings months before the damage hit retail portfolios. There's another pattern worth watching. When too many institutional investors crowd into the same positions, it creates fragility. If everyone owns the same stocks, the exits get crowded when they all try to leave at once. You can spot these crowded trades by analyzing 13F filings across multiple funds. So now you know what signals to watch and how to track billionaire moves. But knowing something's coming and actually doing something about it are two very different things. Let me show you the specific actions they take. Once billionaires see enough warning signs clustered together, they don't just sit there worrying about what might happen. They start making moves. And the first move, the one that separates sophisticated investors from everyone else, is deceptively simple. They build cash. Here's the thing about cash that most people get completely wrong. Holding cash isn't a sign of fear or indecision. It's a strategic position. When you're sitting on cash during a market crash, you're not losing money while everyone else watches their portfolios get cut in half. You're preserving optionality. You're keeping your powder dry for the opportunities that always emerge when blood is in the streets. The average retail investor sees cash as dead money earning nothing. Billionaires see it as ammunition waiting to be deployed. The numbers here are striking. In the late stages of bull markets, institutional investors typically raise their cash positions to somewhere between 20% and 30% of their portfolios. If the market drops 40% and you're holding 25% cash, your portfolio only drops about 30%. More importantly, you now have significant capital to deploy when everyone else is forced to sell. That's not timing the market, that's positioning for probability. The second major move is quality rotation. In the months before crashes, billionaires systematically shift from high-growth, high-multiple stocks to established, profitable companies with strong balance sheets and consistent dividends. They're moving from companies that might be worth a lot someday to companies that are definitely worth a lot right now. Growth stocks can drop 60%, 70%, even 80% during severe downturns. Dividend-paying blue chips might only fall 20% or 30%, and they keep paying you while you wait for the recovery. The third defensive move involves duration reduction in bond portfolios. When interest rates are rising or economic uncertainty is increasing, long-term bonds get hammered. A 30-year Treasury bond can lose 20% or more when rates spike. Smart money responds by shortening duration, moving from long-term bonds into short-term Treasury bills and money market instruments. This is exactly what happened in 2022. Investors holding long-duration bonds got crushed. Those who shortened duration months earlier were barely scratched. The fourth move is sector tilting toward anti-fragile industries. Utilities, healthcare, consumer staples. People still need electricity during a recession. They still buy toothpaste. They still go to the doctor. These sectors don't produce exciting returns during bull markets, but they don't collapse during bear markets either. Finally, billionaires eliminate leverage before crashes. Any borrowed money gets paid off. Margin positions get closed. If you're 50% leveraged and the market drops 30%, you don't lose 30%, you lose 45%. And that's before the margin calls force you to sell at the worst possible moment. All of these moves happen gradually, over 4 to 6 months, while everyone else is still celebrating. But defense is only half the equation. The really smart money is also positioning to profit from crashes. Here's the thing that drives me nuts about how most people think about market crashes. They see crashes as disasters to survive. Billionaires see crashes as opportunities to exploit. That mindset difference alone is worth more than any specific strategy I could teach you. Think about what Warren Buffett was doing during the depths of the 2008 financial crisis. While ordinary investors were panic selling and pundits were predicting the end of capitalism, Buffett was writing checks. He invested $5 billion in Goldman Sachs at terms so favorable they essentially amounted to a rescue with profit attached. He put $3 billion into General Electric. He bought Burlington Northern Santa Fe Railroad for $44 billion. These weren't gambles. These were calculated moves made possible because he spent years building the cash position that allowed him to act decisively when everyone else was paralyzed. The dry powder strategy is really about this exact dynamic. Cash isn't just protection during the crash, it's ammunition for the aftermath. When the VIX spikes above 40, when talking heads are using words like unprecedented and catastrophic, when your coworkers swear they'll never invest in stocks again, that's precisely when quality assets go on sale at prices that won't be seen again for a decade. But you can only take advantage if you have cash to deploy. Most investors don't, because they were fully invested right up until the crash forced them to sell. Here's a strategy sophisticated investors use that most retail investors have never considered. They maintain what I call a shopping list. Before any crash happens, they've already identified the specific companies they want to own at lower prices. They've already calculated the entry points that represent compelling value. When Apple drops 30%, they know exactly whether that price represents a buying opportunity or if they'd want to wait. There's no emotional decision-making in the moment because all the analysis was done months earlier. The shopping list approach eliminates one of the biggest problems investors face during crashes: paralysis. When markets are collapsing, your brain goes into fight or flight mode. Making complex financial decisions in that state is almost impossible. But if you've already decided what you want to buy and at what price, the decision becomes mechanical. Beyond cash deployment, billionaires also use hedging strategies most retail investors don't understand. Put options can provide downside protection without requiring you to sell positions. The ultra-wealthy often buy puts on major indices as insurance. If the market drops, the puts increase in value and offset losses. Carl Icahn reportedly made over $1 billion during the 2020 crash using exactly this kind of hedging. The contrarian buying trigger is another key element. When the VIX spikes above 40, historical data shows that buying at those moments leads to strong returns over the following year. The catch? Buying when fear peaks feels absolutely terrible. Every instinct screams at you to sell, but billionaires who've been through multiple cycles understand that their emotions are the worst possible guide. Now I know what you're thinking. That's great for billionaires. But how does this apply to someone without billions? Let me break that down. So here's how this actually applies to you. Let's be completely honest about what you can and can't replicate from the billionaire playbook, because pretending you have the same resources as Warren Buffett is a recipe for disappointment. What you can't do: you can't move markets, hire teams of analysts, or access sophisticated hedging instruments requiring millions in minimum investment. You don't have personal relationships with CEOs who give you early insights. You can't negotiate sweetheart deals with desperate companies the way Buffett did with Goldman Sachs. These advantages are real, but here's what you absolutely can do. You can watch the same public indicators that billionaires watch. The yield curve is free to check on Fred. Credit spreads are published daily. 13F filings are available on the SEC's website. Insider trading data is aggregated by multiple free services. The information gap isn't as wide as you might think. The real gap is discipline and preparation. Here's what I recommend for most people. When warning signs start clustering, when the yield curve inverts and credit spreads widen and insider selling spikes, start building a cash position of 10% to 15% of your portfolio. This isn't about timing the market perfectly. It's about positioning for probability. You might be early. The market might keep rising for another year. Thanks for watching. The next time in a VAR, that's subscribe to the day. But when the crash does come, you'll have dry powder ready. For the defensive rotation, you don't need to pick individual stocks. Low-cost ETFs make this incredibly simple. Consumer staples ETFs, utility sector funds, healthcare ETFs, these give you instant diversification within defensive sectors for expense ratios of just a few basis points. When you see warning signs, gradually shift some allocation from growth-heavy funds into these defensive positions. The shopping list concept works exactly the same at any portfolio size. Before any crash, identify the specific investments you'd want to buy at lower prices. Write down the prices at which you'd buy and the amounts you'd invest at each level. When the crash comes and your emotions scream at you to sell everything, you'll have a rational plan to follow instead. Here's a practical framework I call the sleep well test. Ask yourself honestly, if the market dropped 40% tomorrow, would your current portfolio let you sleep at night? Would you be forced to sell because you need the money? Would the stress affect your health, relationships, or work? If the answer is yes, your portfolio is too aggressive regardless of what the indicators say. Finally, consider pre-committing to dollar cost averaging during crashes. Set up a plan now. When the market drops 20%, you invest an additional amount. When it drops 30%, you invest more. When it drops 40%, you deploy the rest of your cash. This removes emotion entirely. You're not deciding whether to buy during panic. You're executing a plan that past you created when you weren't experiencing financial stress. The realistic timeline here is important. You won't time the exact top. Nobody does. What you're aiming for is being generally right, not precisely right. If you start getting defensive 6 months early and the market rises another 10% before falling 40%, you still come out ahead. Let me pull all of this together into the complete framework. So there you have it. The complete billionaire crash playbook that most investors will never learn because they're too busy chasing the next hot stock to do the boring preparation work that actually matters. The warning signs to watch. Yield curve inversions that have predicted every recession for 50 years. Credit spreads that reveal when institutional fear is rising. Insider selling patterns that show what company leaders actually think. And 13F filings that let you track exactly what billionaires are doing with their money. All publicly available. All free, all hiding in plain sight while 99% of investors never bother to look. The action sequence is straightforward. Watch the indicators. When multiple warning signs cluster together, start building a cash position of 10% to 15%. Rotate gradually toward defensive sectors. Create your shopping list of quality assets you want to own at lower prices with specific entry points already calculated. Then wait, knowing that your preparation gives you an edge that 90% of investors simply don't have. The 6-month advantage isn't about predicting exact timing. Nobody can do that consistently, not even the billionaires. It's about being ready before everyone else. Having cash when others are forced to sell. Having a rational plan when others are paralyzed by fear. Positioning yourself to buy quality assets at fire sale prices while the talking heads predict the end of capitalism. Here's the real edge that separates wealth builders from everyone else. And it's not what you think. It's not better information. Billionaires aren't operating on secret data you can't access. The real edge is discipline and preparation. It's doing the boring work of watching indicators and building shopping lists and maintaining cash positions when everyone thinks you're crazy for not being fully invested. It's having the emotional fortitude to buy when every instinct screams at you to sell. Most investors will learn these lessons the hard way. They'll panic sell at the bottom of the next crash, lock in devastating losses, then watch helplessly as the market recovers without them. They'll swear they'll be better prepared next time. But when the next crash comes, they'll make the same mistakes because they never built the systems that force rational behavior during irrational times. You don't have to be one of them. The game is still tilted toward those who prepare. But now you know the rules. You know what signals to watch. You know what moves to make. You know how to think about crashes as opportunities instead of disasters. When the next crash comes, and there will always be a next crash, you'll be calmly following your playbook while everyone else is panicking. Your future self will thank you for doing this preparation now. Follow this sequence, and you'll be building wealth while everyone else is still wondering what happened to their retirement account.